Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, July 27, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And we had an interesting day out here. We're starting to get some movement around the markets, so we have a little bit more to talk about, which is good. So the SPDR, as you can see, came all the way down basically to the gap fill. And my level of 245.40 was slightly below that. That was a level that we've had on the chart for quite some time. That's more of a mathematical level. The gap fill level, which you can see here, was 245.66. And let me move the chart over. And then you can see that the low today was 245.68. So we came within 2 pennies of filling the gap and reversed and finished quite decently on the day based on how we were earlier in the day in the early afternoon session. So there was a recovery, and you can see it here. I'll just bring up the 10-minute chart. You can see here, I'm on the wrong time frame. Let me go to the regular session. You can see here that the market took a dip, and then once it hit in that neighborhood at the gap fill level, it recovered and rallied for the remainder of the day. And that some of that is due to the light volume nature of the markets, the summer doldrums. The path of least resistance is up, but we can start to see the cracks in the market. Now, today's volume was certainly larger than we've seen in quite a while, other than 1 or 2 days here and there. We had 70 million shares traded against an average of about 70 million. So it was about on average, and that's the 90-day average volume. Now, I want to talk about a couple of things, and I'm kind of going to circle the wagons a little bit. So bear with me. It'll all come together when I start talking about some of the other indices, and I'll pull everything together. But what I want to say is that, yes, there are cracks, and yes, I think that we're going to have a cycle turn that takes place and puts the market into a corrective state, or easily put, a correction that lasts for at least 2 or 3 months. And I still believe in that call. I believe in that forecast. We are in the window of opportunity, and that window is still wide open. That window is going to remain open through, let's say, the first couple of weeks in August, where I'll begin to start to get concerned that I'm going to be wrong if nothing's happened by, mid to latter part of August. It should really take place before that date. So let's call it the second week of August, give or take, is really where my window begins to get a little bit sketchy. But up until that point, the window's wide open, and the market could make a turn at any point in time in this time frame or in this zone. Now, yes, we did see some cracks in the armor today, if you will, and I'm going to go over some more of those. But what I want to point out, and I'm going to bring over a futures chart, and this is the S&P E-mini futures. This is the continuous contract. And the reason why I want to bring this up, because I think it's important to realize where the futures are in terms of numerology, okay? And what I mean by that is we're at 2472. That number in and of itself isn't necessarily that meaningful. However, you can see here we're still making a bullish pattern on the daily chart, just the same as the SPDRs. It really looks the same. It's the same as the S&P 500. It's just another vehicle. However, what I want to point out is I don't think it's out of the realm of possibility before this rally is over, and I mean over before a correction begins, that the S&P 500 E-mini futures contract, or the S&P futures contract as a whole, gets up near, maybe reaches 2,500. Maybe it comes up a few points short. Maybe it goes over by a few points, but I think that big, healthy, fat, round number of 2,500 is in the cards before this entire bull rally is over. And I'm not saying that the bull rally is over for years to come. That's not what I'm saying. All I'm saying is that we're going to have a healthy correction, and then we're going to resume the uptrend. I don't necessarily have to believe or say that the highs that we see now, whether it's here or at 2,500 on the S&P futures, for example, I'm not saying that that's going to be the ultimate high. That's not what I'm saying at all. But I do think we're going to have a healthy correction, and it's going to last for a little while. It's also going to change the character of the market while it's happening, and it's going to change the conversation. They'll have to place blame on the bear market that will last. It'll be a short-term bear market. I'm just calling it a bear market. Doesn't have to be prolonged, but it's going to be a trend change, and it's going to be a correction if I'm right, and it's going to change the conversation. They're going to have to pin it on something. Maybe they pin it on something like a geopolitical issue. Maybe it's North Korea. Maybe it's Iran. Maybe it's Russia. Maybe it's President Trump. It's going to be something that sets the market off in a downward direction, and that will become the reason why. But you and I both know, and you've been around here, most of you have been around here long enough, that that's just the excuse after the fact. We talk for a long time about turns coming in the market, and when they come, they always have to assign a reason after the fact, but we all know that it's just a cycle taking hold, and the reason is in fact after the fact. All right, so I wanted to point out the futures, and I wanted to just make mention of, and I really haven't talked about this at all, that I've got my eye on the round number of 2,500. Maybe it stops short at 2490, 2495. That's certainly possible. I wouldn't necessarily discount the fact that it could come up a few points short, but I'm using 2,500 as a general round number. I'm not putting it past the market to get there. All right. Back to the spider. So the spider, even though we came down to test some lower levels today, fill the gap, it's still a bullish pattern, and therefore, this market is still in an uptrend. There's nothing technically wrong with the market. There was certainly no technical damage done today, even though we had, a little bit of a down day earlier in the day. In the big scheme of things, it was just a rounding error, and the market basically finished, the S&P finished down 2 points. So nothing happened at the end of the day, and nobody really cares. All right, let's start peeling back the onion a little bit more. Let's go over to the IWM. Now, the IWM was down yesterday, and it was down again today, another 0.6%. Again, I'm looking at it as a potential canary in the coal mine, and the important thing that I want everybody to realize is the IWM, as my favorite leading indicator, where it closes this month, if it can close above this upsloping trend line, is important. If it doesn't, it'll be another month that we're not able to close above that trend line, and therefore it still has the corrective nature of what I'm expecting in terms of the cycle turn intact. If we shoot higher and close above that trend line at the close of July, it's going to be meaningful to all the markets because the IWM is in fact a leading indicator of the larger picture of where the market is generally headed. So I'm watching it certainly like a hawk. This isn't what I wanted, but you could see the 10-minute chart. This is not the same look as the spiders. Let me bring up the spider and then I'll go back to the IWM. You see the spider rally up into the end of the day? That was more of a significant rally into the end of the day than the IWM. What did the IWM do? It basically put in a bearish pattern towards the end of the day. It bounced off the lows, but this is a bearish pattern. It's not the same look as the spider. So I'm paying very, very close attention to all these markets, as you know. Before we get to the transports, which are interesting, I want to go to the VIX. And let me go back to the daily. Here we go. Now, how many times have we said that anytime the VIX gets down below 10, it creates a buying opportunity? Don't care what vehicle you buy, whether it's the exchange-traded products, the leveraged exchange-traded products, call options on the VIX like I have. It doesn't matter. The point is it never stays down here for very long. I'm not suggesting that it can't go into the 9s and even the 8s again. Yesterday, we were in the 8s. Yesterday, we went as low as 884. That didn't last too long, but you can see here the low is 884. But we talked last night about the fact that this was a potential reversal candle yesterday in the VIX. And look what happened today. We shot up very high when the market was selling off in the middle of the day, and then we backed off. But this is a shot across the bow. It's a crack in the pavement, if you will, a canary in the coal mine. Again, when the market does have its correction, the VIX is going much, much higher. But this is just the start, right? Whether today was the start, which I'm not sure it is, or the start is next week or the week after. Either way, the VIX has much higher to go. And if it goes back below 10 again, into the 9s, 950, even into the 8s, it's a buying opportunity. It's not going to stay down here for very long. I have said this literally dozens of times. I'm basically standing on the table, pounding my chest, saying, if you have any confidence in what I do for a living, if you have any confidence in my forecasts over time, then you will be a buyer of the VIX down below 10. It's an opportunity, believe me. And you guys know that I typically don't do that. I don't have that kind of conviction on a call. I'll tell you what I think. I'll tell you I think it's going to rally. I think it's going to fall. Here's the pattern, and we move on. But very rarely do I pound the table. I'm pounding the table on the VIX below 10 and have been for a long time. All right, here's the market that's most interesting to me, the transports. Now, the transports were down 294 points, over 3% today. And we talked the other day, yesterday, in fact, about the bearish pattern that was developing from the down move that started last week, okay? We had the down move when the market was going, sideways to higher, the stock market, the transports were selling off. And I said that the 50-period moving average probably wouldn't hold because we consolidated above it. And I said if we consolidate any longer above the 50, you could forget the 50. It's not going to have any importance whatsoever. Well, guess what? Today we cut through the 50 like a hot knife through butter, headed right to the 200-period moving average. Came up short, but this was the bearish pattern that's playing out or played out. But it's not just that. It's not just the fact that the transports were down today and the S&P 500 was down 2 points and the Dow was up 85 points and the NASDAQ was down 40 points, right? That's nothing. This is interesting, it's meaningful, and it's something we need to pay very, very close attention to. In fact, I got a great comment from somebody today, and I have a license to use this comment, so it's not my own. I'm using it by license, though, and it was that the transports were absolutely murdered today, and there's an open homicide investigation going on, and that couldn't be more apropos for the transports today. 300 points down is a big day. It is a big shot across the bow. This is a wide-ranging day. Near the highs, not at the highs, but near the highs. This is generally telling us there's lower prices coming. Now, are we going to go straight down from here? Probably not. We'll probably get a dead cat bounce. We'll probably put in a bearish pattern for a week or so, and then there's going to be lower prices coming in the transports. I'm watching them very closely, also watching like a hawk. So gold is up about $9. It was up more earlier, and here's my take in gold. I think gold continues higher. I'm not so sure that gold is ready to roll over just yet. So what I will tell you is that if we consolidate sideways for a while, that would build some energy for higher prices. Here's what I'll say with gold. If in fact, and I'm not saying we will, but if we did get to double top around 1,300 in this neighborhood, all right, if that happened, and we know that the gold market can move fast, so we can wake up one day and gold could be up 20, 30 bucks, no problem. Happens all the time, up or down. But if we did get to double top, 1,300, 1,305, in that neighborhood, what I'm here to tell you is it's a stone cold short. That's the way I'm looking at it. If we get there and we've gotten there through a different manner, meaning we consolidated, before we got there for a long time and we're building energy to go much higher, we'll obviously talk about it then. But as it stands now, if we find a spike in gold and we get up in rapid fashion up to 1,300, and I'm just saying if we do, then it's a stone cold short. Right now, what we're doing is finding some daily resistance at the 618 retracement, which comes in right where we are right now, right about 1270, 1269. That's a 618 retracement from pivot high to pivot low, and we hit it yesterday. We hit it again today. We're likely to stall out here for a few days. If we consolidate, then it's going to build energy to go to the next level, which would naturally be the 7.5 retrace. And if we got through that, then we could get up to double top. But one step at a time, we'll see where it goes. Right now, it's generally going to stall out for a couple days and consolidate. So near term, there's really no trade in gold. We should find resistance and are finding resistance where we were, where we are now. And we already talked about the fact that this is a big level with all this chart consolidation back here, over here, and therefore we're finding resistance at this level again, right around the 1270 level. Not surprising. Similar situation in silver. We're not able yet to close above this red candle high. This was a breakdown candle out of a bearish pattern, right? So we had a down move. Okay, we had a wedge formation. And then this was really the breakdown candle, this red candle. When you have a large, wide red candle like this or a large green up candle, those are breakdown or breakout candles, and they usually mean lower prices coming in the case of a red candle, and that's what we got. And when the market gets back up to that area, it generally finds a resistance point, which we're finding now. We haven't yet been able to close above it. Intraday, we've gotten above it, but we haven't closed above it yet. We're also finding overhead resistance at the 50-period moving average, and it's no wonder because we have, some chart consolidation in this zone. I had the wrong tool. We had chart consolidation in this zone, so it's no wonder that we're finding some resistance in this neighborhood. And we could consolidate here for a while, or we can pull back. Either way, there's no trade short term, other than if a trader wanted to be short against today's high, you could do that. Other than that, I'm going to let it consolidate or pull back and see what happens after that. But anybody that's anybody that's willing or wants to be short the silver market can do so against today's high. That is a legitimate trade. It's a reasonable trade with a reasonable risk reward. But you would have to be short against today's high on a closing basis, on a daily closing basis. Crude oil. So looking at crude oil, we continue to edge higher. Now we're above 49. And I've talked about this a couple of times. We're going to get to $50. Maybe it doesn't get exactly to 50. Sometimes they come up short. We talked about the meaning of that last couple of days. So my take is that they're going to want to reach $50. Maybe it gets to $49.85, $49.90, something like that. There's a retracement level up there at $49.90 and change, I believe. I don't remember the exact number. Maybe $49.92 if I remember correctly. But we're going to get up there most likely. And when we do, that's also an area that a trader willing to and that wants to short the crude oil market can do so up in that neighborhood at around the $50 level. But just be aware, they may not reach 50. They may come up a few pennies short. That happens a lot. They either come up a little bit short to trick the traders, or they pierce through it and they'll get to 50-50, 50 and a quarter, 50-75 possibly. But anywhere in that neighborhood is an opportunity to go short the crude oil market. Can they reach the 200-period moving average all the way up at 51.5? They can. I just don't think they will. It's a little bit far away from my liking. We're a little bit overextended on a short-term basis. The market's a little overcooked, and short-term overbought is really what it is. So it's going to need to pull back, but I think they get it either at or close to 50 before that happens. Bond market, it's really going sideways right now. We had a down day in the bond market, and we talked about this upsloping trend line. I don't have to beat a dead horse on this. There's lower prices coming in the bond market. The bond market is going to want to get to the 200-period moving average, also coinciding with this double bottom area down here, and that's where I believe it's going in the short run. You're going to have a support level in this neighborhood. So whether or not we find support at double bottom or we find support somewhere in between double bottom and this area here, there's going to be support. You see this chart consolidation. There's a lot of pivots around there. There's a lot of reasons why that 151 level, give or take, is going to be supportive of the market. You see the 200-period moving average comes in at 151.13, and just below that is a 50% retracement. So we'll call it 151 for argument's sake. That's at the level in which the market's going to find some support. The pivot low to pivot high, your 50% retrace is right around here, and that coincides with around 51. It coincides with a pierce through the 200-period moving average. You have a breakout here. This is the scene of the crime. Markets like to come back and test the scene of the crime. It just makes all the sense in the world to me. That's where the bond market is heading in the short run. What it does when it gets there and how it reacts at that level is a whole different ballgame. That's one trade, meaning to get down to 151. What happens when we get to 151 is a whole new set of circumstances. But I think that's where we're headed. All right, let's go over to the dollar. Long and wrong the dollar. We had a nice day in the dollar today. Not, terribly a large up day. However, it could be considered the makings of a reversal day in the dollar. I don't know that we found low just yet. I really don't have the evidence. It was not a high volume reversal day by any means, but it was something nonetheless. Whether or not we have lower to go, you know my feeling. There's long-term upside coming in the dollar. I am long and wrong. I'm long from 97. We're down below 94. It is what it is. But I still say the long-term picture is bullish for the dollar. The long-term chart is still technically bullish for the dollar. And here it is. When you look at the monthly chart, okay, even though it's ugly, the sell-off from the highs is ugly, this is an up move, and this is bullish consolidation. However you want to square it. This is a 50-period moving average sloping up into price. There's pivot low down here. This is a breakout candle. I mean, well, this was a breakout anyway, but the point is that this is bullish consolidation. Even as ugly as it is, this will promote another move to the upside. We're still going to 105 or higher in the dollar. I know it doesn't sound like it now or seem like it now, but that's my take. I haven't wavered off that. I won't waver off that until this bullish pattern on the long-term chart is broken, and right now it is not broken. As ugly as it is, it's still bullish. And with that, it's everything I wanted to discuss tonight, so I'm going to wrap it there. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.